When I see a market sitting only a few percentage points below its highs, and people already acting as if the world is cracked open, I pay attention. I do not pay attention because panic is pleasant. I pay attention because panic is useful. Useful is the right word. Fear does not ring a bell at the bottom. It does not send a polite notice. It does not say, "Warren." Now is the exact clean moment to act. Fear comes in fragments. It comes in ugly candles, widening spreads, louder anchors, darker forecasts, and investors who suddenly talk as if the future itself has been canceled. That is the environment I care about. What we have in front of us is not simply a market reacting to a war headline. That is the easy explanation. And easy explanations are usually too cheap to be trusted. The market had already spent months telling you something was wrong. It had been moving sideways. Leadership had narrowed, valuations had stretched. The giant winners that carried sentiment, especially around the artificial intelligence trade, were showing signs of exhaustion. The argument over interest rates had not been resolved. The market had already traveled a long distance off the lows in a short period of time. A great many people were still pretending that a tired market was a strong market because the index had not yet broken dramatically lower. That is not the same thing. Then the world handed traders a fresh accelerant. War headlines pushed commodity fears back to the center. Oil became the transmission line for emotion. Volatility rose, protection became expensive. Sentiment collapsed faster than the index itself. And what looked on the surface like a market that was only down around 5% from the highs began to behave internally like a market under much more stress. That mismatch matters. Most people think panic should show up only after prices have already been destroyed. They expect a crater on the chart before they accept that fear is real. Markets do not work that way. Markets can remain deceptively close to the highs while the internals deteriorate. Positioning gets unwound. Leadership rotates, and large pools of capital rush to adjust exposure. That is how you get a rolling correction. The index looks stable enough to comfort the casual observer while underneath the surface money is moving aggressively out of yesterday's favorites and into whatever looks safer for the next headline. That is exactly the sort of market that confuses people. They look at the index and say, "This does not seem too bad." Then they look at sentiment, positioning, and the price of protection. And they realize the room is already full of smoke when asset managers start dumping risk at a pace associated with major fear events. I do not treat that as trivia. When measures of sentiment approach the kind of levels usually seen during broad panic, I do not ignore it. When the cost of buying downside protection rises to levels associated with prior fear extremes, I do not wave it away because the headline index still looks respectable. Those are signs that the emotional condition of the market has moved faster than the index itself. That often happens near important turning points, though not always at the final turning point. There is a difference between panic and a final bottom. Intelligent people learn that difference. Panic tells you opportunity is beginning to enter the room. It does not guarantee that the first price you see is the best price you will ever see. That distinction is where discipline lives. A great many investors lose money because they demand certainty from an environment that only offers odds. They want the market to stop being dangerous before they become interested. By then the bargain is usually gone. So I start from a simpler place. I ask what the market was doing before the headline that everyone is obsessing over. That question clears away an enormous amount of noise. Before the war shock intensified, the broad market had already been stuck in a range for months. It had not been making effortless new progress. It had not been acting like a healthy market carrying broad conviction. It had been acting like a market digesting excess. Stretched valuations were part of that. Exhaustion in the AI leadership trade was part of that. Uncertainty around rates was part of that. The prospect of a new Federal Reserve chair was part of that. In other words, fragility was present before the world received the latest reason to panic. That is important because it keeps me from making the lazy conclusion that war alone created the weakness. War can shock markets in the short run. It can absolutely do that. It can hit commodities. It can scramble positioning. It can force repricing in rates, currencies, and volatility. But if you look over long stretches of market history, the stock market has not usually collapsed simply because war existed. The mechanism is more specific. Oil shocks matter. Inflation fears matter. Supply disruptions matter. Sudden changes in confidence matter. Markets do not price war in the abstract. They price consequences. That is why oil matters so much here. When oil spikes, the market hears a different message. It hears higher input costs. It hears an inflationary impulse arriving, at exactly the wrong time. It hears consumers and businesses facing another squeeze. It hears the possibility that the Federal Reserve will be less able, not more able, to cushion weakness. In other words, oil can turn a geopolitical event into a macroeconomic event. Now you have my attention. A market that was already expensive in many places can tolerate a lot of things. What it struggles to tolerate is the combination of fatigue and a fresh inflation scare. The minute oil starts pressing that nerve, the narrative changes. Suddenly the optimistic path that depended on easy cuts and a calm glide in valuations becomes much harder to defend. That is where the fear of stagflation enters. Stagflation is not just an economist's word. It is a very ugly feeling in markets because it takes away the clean rescue that investors keep hoping for. If growth is weakening and inflation pressure is still alive, the central bank does not have the freedom people wanted to have. The dream of multiple cuts becomes shakier. The market has to think harder about what it was paying for and why. Traders who were leaning on a dovish future can discover that the future is not behaving in that kind of tape. Even a market only modestly off the highs can feel much worse than the casual chart suggests. I have watched many investors confuse a rolling correction with safety. They tell themselves the market is holding up because the index has not collapsed. Meanwhile, money is rotating out of the glamorous winners and into staples, energy, and defensive corners. The generals are changing, breadth is deteriorating, people are paying up for insurance. The emotional damage is spreading even if the headline damage still looks mild. That is not safety, that is transition. And transition is where a lot of fortunes are made or damaged depending on whether you are reacting or thinking. When fear reaches extremes, I force myself to remember something most people forget. At exactly the wrong time, the market has lived through terrible circumstances before. It has lived through wars worse than the current one. It has lived through recessions, oil shocks, inflation, policy mistakes, and genuine financial accidents. In many of those episodes, the immediate response was ugly, but the longer-term result for disciplined owners of productive assets was far better than the public mood predicted in real time. The public mood is almost always more dramatic than the long-term outcome. That does not mean every decline is instantly a buying opportunity with no further pain. It means panic should not be mistaken for permanent truth. Even the historical pattern after large oil surges points in that direction. When you get a sudden jump in oil, the market often absorbs the shock, fears the worst, and then recovers over time once the shock stops expanding. There are exceptions, of course. History does not sign legal guarantees. But history does remind us that a commodity shock and a lasting market death sentence are not the same thing. That is why I refuse to talk as if a war headline automatically means a bear market is inevitable. Could a bear market happen? Of course it could. I have been around too long to speak in absolutes, but the base case should not be built from the most frightening headline on the screen. Bear markets are rarer than corrections. Most corrections do not become lasting disasters. If a person structured his entire financial life on the assumption that every correction must become a full-blown bear market, he would spend an awful lot of his life hiding from opportunities. That is no way to compound. At the same time, I also refuse to pretend that because panic creates opportunity, the right move is to buy everything blindly and immediately. That is just greed, wearing a brave costume. I separate trading from investing. The two are not morally different, they are mechanically different. A trader cares about the next swing, the next relief rally, the next failed bounce, the next volatility spike. A trader must care about levels, momentum, catalysts, and timing. A trader has to ask whether a rally is real or merely a rebound in an unresolved mess. A trader can be short, flat, hedged, long, then hedged again, depending on how the evidence changes. An investor with a long horizon asks a different question. He asks whether fear is creating attractive forward returns in assets he would be happy to own when the panic is no longer fashionable. He does not need to know the exact low. He needs to know whether prices are improving relative to long-term value. Those are different games, and confusion between them costs people dearly. If I am thinking like a trader in this environment, I am not interested in behaving as if one ugly down move automatically means the market can only continue straight lower. Oversold markets bounce, panic burns hot, and then pauses, relief rallies happen. That is normal. If you have already benefited from being short into fear, there are times when the intelligent thing is to cover, breathe, and study what kind of rebound appears. That is not weakness. That is professionalism. A relief rally itself tells you nothing. The quality of the rally tells you everything. If the market bounces while the underlying geopolitical problem remains unresolved, while oil remains elevated, while volatility refuses to truly calm down, and while the supposed off-ramp remains vague, then I do not treat that rally as proof that the danger is gone. I treat it as a move that can fail. In that case, hedges may again deserve a place on the table. The market does not owe me one straight line. It can rally, disappoint, and roll over again. The reason is simple. In unresolved fear events, a bounce is often just the market exhaling, not healing. That is the kind of situation where traders can look at a retracement, a gap, a major average, a failed retest, or a volatility condition and decide that risk should once again be pressed in the bearish direction. That is not prophecy. It is conditional reasoning. If the backdrop improves, the view changes. If the backdrop stays poisonous, then a bounce can become an opportunity to re-hedge. I think that distinction is lost on many people. They want a single opinion they can tattoo on their arm. Markets do not work like that. Good operators update, volatility behaves the same way. When fear surges, the instinct of the public is to believe the spike itself is proof that more fear must immediately follow. Sometimes that is true, but volatility can overshoot just as price can overshoot. There are moments when the VIX becomes less a reflection of future wisdom and more a reflection of immediate emotional exhaustion. At those moments, fading volatility can be an intelligent tactic, provided one understands the risk of doing so when the move is not truly climaxed. The principle is what matters. Extremes often contain opportunity because human beings are poor at holding balance under stress. Oil needs the same discipline. I do not like chasing a vertical move in oil after the emotional part of the spike has already announced itself to the whole world. By the time the public has fully embraced the commodity panic, the easy money is often already gone. That does not mean the move cannot go further. It means I do not like paying peak emotional prices unless I have an unusually compelling reason. I would rather think in second-order terms. If oil remains higher for a while, American oil producers can benefit meaningfully. That is a cleaner expression than simply lunging at the commodity after the move has already frightened everybody. If the United States is less directly exposed to the threatened choke point than the public assumes, and if domestic producers stand to gain from higher realized prices, then there are ways to participate in the situation without worshiping the headline itself. Again, this is the habit I trust. I ask who is helped, who is hurt, and what the market is overestimating or underestimating. The market often collapses all nuance into one loud conclusion. Everything is bad, everything is dangerous, everything must be sold. That is how bargains are born. One of the biggest advantages a calm investor can have is the willingness to look where fear is broad, but outcomes are uneven. In the broad index, I can respect the possibility of more downside. A market that is only modestly off the highs can absolutely correct further. Annual drawdowns are not exotic. Midterm years can be rougher. A correction does not become unusual just because it frightens people every time. If a market that is already tired gets dragged lower by oil fear and policy uncertainty, a decline towards something more like a full correction would not violate normal market behavior. In fact, it would fit market history better than the public is usually willing to admit, but that does not make me hopeless. It makes me practical. If the broad market moves down toward the area where a standard correction becomes real, I become more, not less, interested as a long-term allocator. People speak about wanting bargains, but many really mean they want bargains that do not feel frightening. Those do not exist. A real bargain always arrives with an uncomfortable story attached to it. The discomfort is the discount. If the index approaches major long-term reference points like the 200-day moving average, I start paying closer attention, not because a moving average is holy scripture, it is not, but because it often marks the place where the public mood changes from casual confidence to active unease. That is fertile territory for long. Term buying if the businesses underneath still deserve ownership, and that is the other point people miss. I do not need the index alone. I can also look at where the pain has already been severe in individual quality businesses. By the time the public starts worrying about the broad market, some good companies may already be well off their highs, some software names, some mega caps. Some previously beloved compounders may already have endured their own bear markets even if the index has not. That creates asymmetry. The broad market may still have room to correct, but select quality assets may already be offering long-term returns that are far more attractive than the frightened public realizes. That is the sort of place where patient capital gets paid. The public loves certainty. Compounding loves discipline. If I can buy quality in tranches while the crowd is still arguing over whether this decline is about war, oil, inflation, or the Fed, I do not need to win the argument. I need to improve my future return. That is a very different objective. Dollar cost averaging becomes more attractive as fear deepens. Not because every purchase will look brilliant in the next 48 hours, but because repeated buying into real corrections has historically been one of the least glamorous and most effective habits an investor can develop. You do not need the exact bottom. You need courage with a system. Most people have the system when prices are rising. They lose the courage when prices are falling. That is why the return goes to somebody else. I have never believed that cash is a comfortable, permanent answer. Cash can be useful, it can give you optionality, it can let you move when others are trapped, but as a long-term refuge it is a leaky boat. The purchasing power of money erodes. Inflation does not need permission. Time does the work quietly. People who think they are safe because they are doing nothing are often just accepting a slower loss. When they finally do act, it is frequently at a worse price and under greater emotional pressure. That is the cruelty of fear. It first freezes you, then it hurries you. In a market like this, I want to be the opposite of hurried. I want to think in layers. One layer is tactical. If fear is stretched and the market is oversold, I should respect the possibility of a rally. If the rally lacks fundamental relief, I should respect the possibility that it can be faded or hedged against. If volatility spikes into true emotional extremes, I should think about what that means instead of simply joining the scream. If oil is surging, I should ask whether the obvious trade is already too obvious. Another layer is strategic. If the broad market moves into more serious correction territory, if quality businesses are materially off their highs, if long-term reference areas are being tested, I should be increasingly willing to put money to work, not with bravado, with a plan. Plans matter because emotion changes faster than principles. When people panic, they often sell for reasons that have very little to do with long-term value. They sell because they are overextended. They sell because they need liquidity. They sell because they cannot bear watching numbers fall. They sell because the pain of uncertainty becomes larger than the discipline of ownership. The market does not ask whether their reasons are noble. It just processes the order who buys from them. Usually the people who do not need immediate relief and who have trained themselves to view panic as a transfer mechanism rather than a verdict. The assets leave the hands of the forced and enter the hands of the prepared. That transfer has built a lot of fortunes. I am not romantic about it. It is simply how markets work. Fear redistributes assets towards stronger balance sheets and steadier nerves. That is why I say the real question in a panic is not whether you feel fear. Of course you do. The question is whether your process becomes weaker than your fear. If the answer is yes, the market will educate you expensively. If the answer is no, the market can still hurt you in the short run, but it is far more likely to reward you over time. This is also why I do not accept the lazy phrase that this time is different just because the headline is dramatic. Every era believes its own crisis is singular. Every era can list reasons why the old playbook should fail. Now yet productive assets have an extraordinary way of surviving the emotional certainty of the crowd. Human fear changes costume. It rarely changes character. That does not mean I dismiss danger. It means I refuse to worship it. The specific geopolitical issue here, including the threat around the Strait of Hormuz, deserves seriousness. If that channel is threatened, insurers react, shipping behavior changes, commodity markets respond. The world does not need a formal full closure to price risk. Threat alone can do the job. And if that fear spreads into a larger global growth scare while oil remains elevated, then yes, the United States eventually feels the consequences, even if its direct reliance is smaller than popular imagination suggests. But seriousness is not the same as helplessness. Markets begin repricing long before certainty arrives, if both sides are searching for an off-ramp, if the most extreme fears start to moderate, if oil stops screaming, if the volatility complex relaxes, then the market can rebound violently because so many participants were positioned for unending disaster. That is why I always say that panic creates opportunity in both directions. It creates downside for the unprepared and upside for the prepared. A relief rally can be savage. So can the next leg lower if the relief is false? That is why I do not marry a single forecast. I marry a process. My process in an environment like this is very simple to describe and very hard for most people to follow. I acknowledge that the market was vulnerable before the headline. I acknowledge that the headline intensified the vulnerability through oil, volatility, and fear. I acknowledge that panic is now visible in places where it usually matters. I acknowledge that panic alone does not guarantee the final low. I acknowledge that history argues against treating war itself as an automatic reason to abandon equities for the long run. I acknowledge that corrections are normal, further downside is possible, and oversold conditions can still get more oversold before they become a foundation. I acknowledge that when the broad market nears major support areas and quality businesses are already discounted, the investor in me should be increasingly constructive. I acknowledge that traders and investors should not pretend they are doing the same thing. That is enough. I do not need more certainty than that. One of the worst habits in finance is the need to turn a probabilistic environment into a theatrical speech. People speak as if they know exactly how the next month will unfold. They do not. They know what they fear and what they hope. Those are not forecasts. Those are feelings. If there is a Fed meeting on the calendar, if volatility expiration is approaching, if options expiration is approaching, if oil is unstable, then I should expect noise. Noise is not a bug in a market like this. Noise is the environment. A fast rally does not disprove the bear case. A sharp down day does not disprove the long-term opportunity. A headline can stretch a move. A comment can unwind it. This is exactly why process matters more than performance in any single session. A person who cannot sit inside uncertainty has no business pretending to understand markets. The broad public wants a clean instruction. Buy now, sell now, panic now, relax now. I have never found reality to be that generous. Reality usually says something harder: stay awake. Separate time horizons, size positions sensibly. Let price and conditions guide aggression. Add when value improves, hedge when the rebound outruns the evidence. Avoid acting simply because everyone else is louder than you are comfortable with. That is not exciting advice, it is durable advice. I also keep returning to one point that I think matters enormously. A lot of investors believe in buying the dip only in theory. In practice, they are willing to buy tiny, harmless dips that do not challenge them, and then become strangely philosophical when a serious correction finally arrives. Suddenly, they want to wait for clarity, but clarity is expensive. The market sells it at a premium. If the broad market eventually reaches something closer to a true correction, if the kind of drawdown that feels impossible while people are still only 5% off the highs actually shows up, that is not the time for elegant speeches about patience while doing nothing. That is the time to recognize that the market is finally offering what long-term owners claim they always wanted. I think often about the people who look backward at prior fear events and say they would have loaded up if only they had been around then. They point to the pandemic panic, the deep parts of the 2022 decline, the violent scares that came with sudden macro shifts, and they speak as if courage would have been easy. It was not easy then either. It never is. The human mind edits old fear into a neat chart and forgets what it felt like to live through it. Living through it is the price. If you want the return but do not want to pay the emotional price, someone else will collect the spread. That is why I like systems. A system removes the burden of perfect courage. It replaces heroic timing with repeated behavior. Buy some here. Buy more if value improves. Increase exposure when fear deepens into areas that history says are usually rewarding. Stay disciplined when the crowd becomes dramatic. Keep cash available not to hide in forever, but to convert fear into future ownership. That is how real compounding often looks. Less cinematic, more effective. When I listen to the current chatter, I hear two bad instincts battling each other. One camp wants to act as though the war changes nothing and every dip is automatically a gift. The other camp wants to act as though the war changes everything and every bounce is a trap. I distrust both forms of certainty. The wiser view is narrower and stronger. The market was overextended in important areas. The internal correction was already underway. The geopolitical shock intensified fear through oil and inflation anxiety. That fear has now become large enough to create tactical and strategic opportunities. But opportunities still require discrimination. That means I can be open to a tradable rebound while still admitting that an unresolved problem could send the market lower later. It means I can be patient with long-term capital and become more aggressive if broader correction territory opens up. It means I can prefer already beaten up quality areas over blindly chasing broad optimism. It means I can think about energy producers differently from energy itself. It means I can remember that cash is a temporary option, not a permanent answer. Most of all, it means I do not let the public mood write my policy for me. Markets are not moral. They do not reward whoever is angriest, most frightened, or most eloquent. They reward people who can keep their heads long enough to buy what matters when others are too emotional to do so. I have seen enough cycles to know that panic always tries to look permanent. That is part of its trick. It takes a temporary imbalance and dresses it in permanent language. It says always, it says never. It says this time the old logic no longer works. It says the world has changed in a way that invalidates patience. Usually panic is lying, not because the problem is fake. The problem is often very real. Panic lies because it exaggerates the duration, the certainty, and the hopelessness. It borrows truth from the present and then smuggles in fiction about the future. That is why I slow down when others speed up. If the market gives me a relief rally without genuine improvement underneath, I can remain cautious and tactical. If the market gives me deeper correction prices in strong assets, I can remain constructive and patient. If the market gives me confusion, I can insist on not pretending that confusion is clarity. That is enough. I do not need to know whether the next headline tomorrow morning will be better or worse. I do not need to know whether the next candle will be green or red. I need to know whether fear is improving my prospective return and whether I have the temperament to act in proportion to that improvement. That is the whole game more often than people realize when I am asked how to respond to an environment like this. My answer is not a slogan. It is a framework. Do not reduce the sell-off to war alone when the market was already vulnerable. Do not reduce the opportunity to a blind dip, buying reflex when more downside may still arrive. Do not treat a relief rally as a cure if oil volatility and uncertainty still dominate. Do not treat further downside as proof of permanent doom if productive assets are being offered at materially better prices. Do not let the trading horizon contaminate the investing horizon. Do not let cash pretend it is safety when time and inflation are quietly taxing it every day. And do not forget that forced sellers create opportunities precisely because they cannot think about 5 years while they are fighting with 5 hours. That last point matters enormously if people are losing jobs, if artificial intelligence is pressuring parts of the labor market, if inflation anxiety is climbing, if war headlines are hammering confidence. Then more people will behave from necessity instead of strategy. Necessity is the worst portfolio manager in the world. It sells because it has to. It does not ask whether the price is rational. It asks whether the bill is due. The prepared investor can take the other side of that trade, not because he is colder, because he is readier. Preparedness in markets is not genius. It is structure, liquidity, a time horizon, emotional restraint, a willingness to act in tranches, respect for risk, and enough humility to know that bottoms are processes, not magic moments. That is how I see the present environment. There is fear, real fear. There is also opportunity, real opportunity. The market is not broken simply because the public mood is broken. The broad index may still have room to correct. Some quality assets may already be far more interesting than the index itself. A relief rally may arrive, a failed relief rally may arrive after that if the problem remains unresolved. The investor who wants one sentence to remove all ambiguity will be disappointed. The investor who can live with conditional truth has a chance to do very well. I have always believed that your return is shaped not just by what you buy, but by the state of mind in which you buy it. Buying out of envy, buying out of boredom, buying out of panic, buying out of television, induced urgency. All of those states leave fingerprints on the result. Buying out of disciplined opportunism is different. It does not guarantee an immediate reward. It gives you a favorable long-term relationship with uncertainty. That is what I want here. If panic deepens, I want to become more interested in ownership, not less. If relief appears without real repair, I want to keep my guard up. If fear pushes quality into truly attractive territory, I want to add if emotion produces tactical dislocations. I want to notice them without confusing them for permanent truth. The market does not have to become easy for me to find it useful. In fact, It is usually most useful when it becomes emotionally unpleasant. That is when ownership transfers. That is when valuation improves. That is when the public accidentally gives long-term investors what they spend years pretending they are waiting for. So I look at the current panic and I do not ask whether it feels bad. I ask a better question. Who is being forced to think short-term? And what are they throwing away because of it? Some of the answer is in the broad market. Some of the answer is in already beaten-up quality companies. Some of the answer is in the sectors benefiting from the very shock that frightened everyone else. And some of the answer is simply in remembering that a market near its highs can already be sick, that a war can expose a weakness it did not create. And that fear can be both justified in the moment and exaggerated in the larger arc. That combination is where intelligent capital earns its keep. I do not know the exact path from here. No honest person does. But I know this. Panic is finally large enough to matter. The market's vulnerability existed before the latest explosion of fear. Oil has become the crucial messenger. The Federal Reserve is less free than optimists wanted to believe. The public is confusing internal damage with external calm. Traders have tactical opportunities. Investors are moving closer to strategic ones. And anybody who still believes safety means doing nothing with depreciating cash has not learned the oldest lesson in markets. In the end, wealth often moves toward the person who can remain rational while other people are becoming urgent. That has not changed, and I doubt it ever will.